Hedvat here with Bert Hochfeld, former hedge fund manager. Bert, a lot of people, they have gone to business school, they have not been to business school, and they still don't know how to read an earnings report. They're looking at, like they'll say, I'm waiting till earnings. But I don't even know if they really know how to read it. I mean, in the hedge fund industry, what are they looking at on the earnings? What should they pay attention to and not? And try to give us some insight.
First of all, not everybody reads earnings statements the same way. In my particular case, I'm very concerned about the level of stock-based comp. Not everybody is, okay? So, all the earnings you're going to see in tech, all the headlines you're going to see are non-GAAP.
Not general accountancy principles. But,
generally accepted accounting principles, okay? So, all the earnings you see are non-GAAP. And that's fine. But if I see that the reason for a beat was because stock-based comp shot up, I'm not going to pay too much attention to that, nor should you. Because, you know, it's not real, okay?
Okay, so you're the CEO and you're the chairman and you decided to change the stock-based comp, meaning you're reporting.
You don't get to decide to change the stock-based comp. Thank God we haven't gotten to that point. But
well, so how does that change the earnings? I don't even understand that.
So let's say I go out and I hire 1,000 developers, okay?
Software developers.
Yes.
Okay.
And software developers will not get hired if we don't give them stock options, okay?
Okay.
I can pretend that didn't cost me money, but of course it costs money. And there is something called Brent-Scholes, that is a formula that you use to calculate stock-based comp, okay? It's not a formula that I am the fondest of in the world, but...
Black-Scholes?
What? Yeah.
So basically, if you're not paying these developers and you're giving them stock, you're spending less money and maybe your earnings went up.
That's what you'll see, but of course earnings didn't go up.
I see. So, first of all, you're looking, is this for real? Does this company make more money or they just spent less on salaries?
That inevitably, I see oftentimes that companies beat their numbers not because their operational performance improved, but because they spent more on stock-based comp, and so I'm supposed to accept the fact that they didn't spend money on R&D or selling expense or whatever. Now, that's one thing. So I start with that. I really would actually like to know what the earnings are. The second thing I want to know is, as I mentioned, I want to know what product bookings are. In this day and age, when people are migrating en masse to consumption options that are not based on a perpetual license sale, I'd like to know exactly what my product bookings are. That's really how I can judge the demand for the product, the viability of the company's competitive positioning, the sales execution capability. So I look at product bookings. Nowadays, because of duration issues, I really prefer to know what's called ACV, annual contract value. I want to know what the annual contract value was that a company signed during a particular quarter. Almost all of them will tell you that, not all of them, but most of them will. If you know what the ACV was this quarter and you compare it to a year ago and last quarter, you have a far better idea about what's going on. I always want to take a look at the GAAP-based expense ratios. How much does it cost to sell $1 of ACV? Okay, it's very. Somehow I have this old-fashioned idea that it probably ought to cost less than $1 to get $1 of ACV. Not all companies are focused like that. If they're not, that's troublesome.
Mm-hmm.
I want to know the dollar-based net retention ratio. How much, if a company collected $100 from its customer base in 1 year, how much more is it the next year?
How long their subscribers are staying with them, to make it simple, but
Well,
they're not all paying the same amount, but how long are these people staying with the company? Is that what you're
more
saying?
than that, are they buying more? Are
Are
they buying more seats? Are they buying more modules?
So, what we see usually is Microsoft Beats. They earned 8 cents a share on 29 cents of revenue. But where are they going to find these specialty numbers that you're looking out for?
They're all reported.
It's,
They're either reported in the earnings release, in the supplemental disclosures, or on the conference call. I don't have second sight.
Mhm.
If they weren't reported, where would I find them? Oh, we forgot to mention the tax rate. IBM reports a 6% tax rate last quarter. Do you think that IBM's earnings for the period were good or bad? Well, if you think that a 6% tax rate is a sustainable tax rate, that's one thing. But the fact is that using a normalized tax rate would show that IBM missed its operating numbers by something like 40 cents a share. Of course IBM had a troublesome quarter.
Yeah. So, is there anything that... Okay, sometimes the earnings come out and the stock moves very wildly. Is there one thing that is in order? Like, people should look out for something before anything else?
Yeah, they have to look out for bookings before anything else.
Booking, so new customers.
No. The dollar-based bookings that a company generated in a given quarter. I mean, basically, you calculate bookings by the amount of product revenue plus the change in the net change in deferred revenue.
What is deferred revenue?
If I sell somebody a 3-year deal or a multi-year deal, I sometimes, there's two kinds of deferred revenue. I'm sorry to introduce this complexity. There is deferred revenue where you get paid cash up front.
Okay.
So a guy says, I'm contracting to buy 10,000 seats of Salesforce modules 1, 2, and 3 for a 3-year term, and I'll pay you up front. And that's deferred revenue. Since I'm only allowed to recognize revenue for the period in which the product was installed in the quarter it was installed, instead of reporting a large number, I report a minute number. Okay? But sometimes the customer says, I'll make a deal and I will promise to pay on the first of the year $1,000 for the next 5 years.
Okay.
That's called an off-balance sheet deferred revenue, because they didn't pay the cash.
I see.
But it's a contractual commitment on the part of a high-quality credit. I mean, if GM makes that commitment, or Ford or Macy's, they're going to pay it.
Yeah.
So you want to know how much a company booked in a given quarter. That's the first thing you want to know. At least the first thing I would want to know.
Yeah. Good to know. All right. Thank you very much, Bert.